Most traders think their biggest enemy is a bad trade, a wrong entry, a stop that got hit. But what if I told you that even your winning trades are slowly bleeding you dry? There is a hidden tax in trading that nobody talks about. It does not show up on your broker statement. It does not have a name, but it is eating your profits every single month, and you have no idea it is happening. By the end of this video, you are going to understand exactly what this hidden tax is, where it comes from, and how to stop it from killing your account. This is not about spreads or commissions. This is something far more dangerous because it lives inside your own decisions. I have spent years studying why traders who do everything right still end up losing. They follow their plan. They use proper risk management. They hit their targets. But at the end of the month, the numbers do not add up. Their account should be growing. It is not. And the reason is almost always the same thing. The hidden tax I am talking about is called trading friction, not the mechanical kind your broker charges, the behavioral kind, the small, invisible costs that come from hesitation, overtrading, bad timing, and emotional decision-making. Every single one of those moments has a price, and most traders are paying it without ever knowing. Before I break this down, I want to be clear about one thing. This is not theory. I am not reading from a textbook. Everything I am going to show you today comes from watching real traders, studying real accounts, and understanding the specific patterns that quietly drain money out of even the most disciplined setups. If you have ever felt like your results do not match your effort, this is exactly why. So let me explain what trading friction actually is in simple terms. Imagine you set up a perfect trade. Your analysis is correct, the setup is clean, you have a target and a stop. But somewhere between identifying the trade and closing it, something small goes wrong. Maybe you move your stop. Maybe you exit early. Maybe you hesitate on the entry and get a worse price. That gap between the perfect version of the trade and what actually happened is friction, and it has a cost every single time. The problem is that each individual moment of friction feels tiny. You moved your stop just a few pips. You exited a bit early because you were nervous. You entered a little late because you wanted more confirmation. None of those feel like big deals in isolation, but stack them across 10 trades, 20 trades, a full month of trading, and the number gets ugly fast. This is the hidden tax. It is not one big loss. It is 1,000 small ones that never show up clearly on any single trade. Let me walk you through the most common forms of this friction so you can start recognizing them in your own trading. The first one is entry hesitation. This is when you see your setup, everything lines up, and instead of pulling the trigger, you wait. You want just a little more confirmation. You want the candle to close. You want to see one more thing. And by the time you enter, the price has already moved. Your original risk to reward was 1 to 3. Now it is 1 to 1.5 because you paid the hesitation tax. The trade might still win, but you already gave away a portion of that profit before the trade even started. Here is why this matters more than most traders realize. If your strategy genuinely gives you a 1 to 3 risk reward, and you are consistently entering late and turning it into a 1 to 1.5, your entire edge is cut in half. The system that was supposed to build your account is now barely breaking even, and you will sit there wondering why your strategy is not working when the strategy was never the problem. The execution was. The second form of friction is early exits. This one is deeply emotional, which makes it harder to fix. You are in a trade. It is moving in your direction. Everything looks good, and then the market pulls back for 30 minutes. It does not hit your stop. It is just consolidating, but your mind starts talking. What if it reverses? What if I give back these pips? What if this is the top? And so you close the trade early. You grab 40 pips when your target was 90. The market then continues another 60 pips to your original target without you. You did not lose, but you left more than half the trade on the table. That is the hidden tax on every single early exit. The emotional trigger behind early exits is the fear of a winning trade turning into a losing trade. That specific fear is one of the most powerful forces in all of trading psychology. It overrides your plan. It overrides your analysis. It makes a winning trade feel dangerous. And every time you give into it, you pay the tax. You shrink your actual results versus what your system was capable of producing. The third form of friction is revenge trading after small losses. This one is tricky because it does not always look like revenge trading in the moment. You take a loss. It was a valid setup. It just did not work. But instead of moving on, something in your brain pushes you to find another trade immediately. You need to get that money back. So you look for a setup that is not quite there. You force an entry that does not meet your criteria. And that second trade, the one born out of frustration, loses. Now your day has gone from one planned loss to 2 losses. And the second one was completely avoidable. What makes revenge trading so expensive is that it always targets your daily or weekly results results right when they are already fragile. You were down 1 unit. You are now down 2 or 3, and that bigger drawdown starts affecting your mindset for the rest of the session. One emotional trade does not just cost you that trade. It shifts the entire psychological frame you are operating from for the next several hours. The fourth form of friction is position sizing inconsistency. Most traders know their risk percentage. They know they are supposed to risk 1 or 2% per trade. But in practice, the sizes jump around based on how confident they feel. When a setup looks really clean, they go in heavier. When they are on a losing streak, they drop the size way down. When they are on a win streak, they bump it back up. The problem is that your confidence level and the actual quality of your setup have almost no relationship. A setup you feel amazing about has the same statistical edge as a setup you feel unsure about if they both meet your criteria. Inconsistent sizing means your biggest positions are often in the trades where emotion, not analysis, is driving the decision. Think about what that does over time. Your losses on oversized trades hit harder. Your undersized wins do not recover the drawdown the way they should. The math of your strategy gets distorted because the position sizes do not reflect a system. They reflect your mood, and your mood is not a reliable trading tool. The fifth form of friction is the spread between your plan and your execution on stop losses. You set a stop. The trade goes against you. The stop is close to being hit, and you move it. You give it just a little more room. You tell yourself the setup is still valid. Maybe it is, maybe it is not. But that move, that one decision to shift the stop further away, is one of the most expensive habits a trader can have. It turns a controlled loss into a larger loss. It trains your brain to believe the stop is negotiable. And once your brain learns that, the discipline around every other rule in your system starts to erode as well. Stop moving is not just a money problem. It is a psychological infrastructure problem. Every time you move that stop, you weaken the part of your trading mindset that makes the entire system function. Rules that bend once will bend again. And a system built on rules that bend is not a system at all. Now here is where this gets really important. All 5 of these friction points share something in common. None of them are caused by a bad strategy. None of them come from poor market analysis. They all come from the gap between knowing what to do and actually doing it under pressure. That gap is the hidden tax, and the size of that tax determines whether your trading career succeeds or fails, regardless of how good your system is. Let me give you a concrete example of how this adds up. Imagine a trader with a strategy that produces a genuine 1 to 2.5 risk reward with a 55% win rate. On paper, that strategy is profitable. It should build an account steadily over time. But now apply the friction. Entry hesitation reduces the average reward from 2.5 to 1.8. Early exits cut that down further to 1.4. One revenge trade per week adds an unplanned loss. Stop moving occasionally turns a 1-unit loss into a 2-unit loss. Position sizing inconsistency means the bigger losses are always on the larger positions, and the wins are often undersized. That same strategy, with the same analysis, with the same win rate, is now losing money. Not because the strategy failed, because the friction tax consumed the entire edge. This is why so many traders switch systems constantly. They think the problem is the strategy, so they try a new one, and the new one works in backtesting. But they bring the same behavioral friction to it, and it produces the same disappointing results. The strategy keeps changing, the friction stays the same, and nothing improves. So how do you actually start reducing this tax? The first step is measurement. You cannot fix what you cannot see. Start tracking your trades in a way that separates your planned trade from your actual trade. Every entry, write down where you plan to enter and where you actually entered. Every exit, write down your target and where you actually closed. Every stop, note whether it was moved or honored. At the end of each week, calculate the difference. That number, the gap between your planned performance and your actual performance, is your friction cost. Once you see it as a number, it stops being abstract. It becomes something you can work on. The second step is creating a pre-trade checklist that slows down the moments right before execution. Most friction happens in the 2 to 3 minutes before you place a trade or manage an open position. Your emotions are highest. Your rational thinking is lowest. A physical checklist, something you literally read out loud before touching the trade, forces a pause. It breaks the automatic emotional response. It gives your analytical brain a chance to catch up with your emotional brain. The checklist should ask simple questions. Does this entry meet all my criteria? Is my stop in the right place? What is my target, and am I willing to hold to it? Have I already had a loss today that is affecting how I feel right now? The third step is what I call a friction audit. Once a month, go back through your trade log and tag every trade that had some form of friction. Early exit, late entry, entry, moved stop, oversized position, revenge entry. Count them, add up the cost, see it in total. Most traders who do this for the first time are genuinely shocked by the number, not because each individual incident was catastrophic, but because the cumulative total is enormous. That monthly number is the hidden tax written out clearly, and once you see your friction tax every month, you get very motivated to reduce it. The fourth step is building what is called a cooling off protocol for after losses. Before you are allowed to place the next trade after a loss, you must complete a short reset. Stand up, walk away from the screen for at least 5 minutes. Write one sentence in your trading journal describing how you feel right now. Then read your trading rules out loud once. Only after that are you permitted to look for the next setup. This sounds simple and almost too easy, but it works because it physically breaks the emotional state that leads to revenge trading. It is a circuit breaker for your psychology. The fifth step is fixing your position sizing by removing discretion entirely. Do not decide your size trade by trade based on how you feel about the setup. Build a simple calculator into your routine. Every trade gets the same percentage of risk, period. No exceptions for high conviction setups. No exceptions for low confidence setups. If it meets your criteria, it gets your standard size. If it does not meet your criteria, you do not trade it. Removing the discretion removes one of the most consistent and expensive sources of friction in the average trader's account. Here is the connection that most traders never make between reducing friction and actually making money. The edge in most profitable trading strategies is not enormous. Profitable systems tend to produce modest but consistent mathematical advantages over a large sample of trades. That edge might be the difference between a 1.8 average reward and a 2.2 average reward, or the difference between a 52% win rate and a 56% win rate. These numbers sound small, but over hundreds of trades, they determine whether your account grows or slowly dies. Behavioral friction eats directly into those margins, and when the margin between profitable and unprofitable is that thin, every source of friction matters. The traders who actually build accounts over years are not necessarily the ones with the best analysis. They are the ones with the lowest friction. They enter when they are supposed to enter. They hold when they are supposed to hold. They exit when they are supposed to exit, and they do not deviate based on how they feel in any given moment. The strategy delivers its edge. The execution does not corrupt it. That is the entire formula. Think about what your account would look like over the next 12 months if you reduced your friction tax by just 30%. Not eliminated, just reduced. Your entries improve slightly. Your hold time on winning trades improves slightly. Your stop discipline holds more consistently. Your position sizing becomes uniform. None of those changes are dramatic, but together they allow your actual results to get much closer to what your strategy is theoretically capable of producing. And for most traders, that gap between theoretical and actual performance is where all the profit lives. The money you are leaving on the table right now is not in a better strategy. It is not in a better indicator. It is not in a different market or a different time frame. It is in the friction between your plan and your behavior. That is the hidden tax. And unlike commissions or spreads, you actually have full control over it. You can reduce it. You can track it. You can systematically shrink it over time. And as you do, your results shift without changing a single thing about your analysis or your system. Start this week. Pull up your last 20 trades. Look at where you plan to enter versus where you actually entered. Look at where you plan to exit versus where you actually exited. See if any stops were moved. Add up the friction cost across those 20 trades. That one exercise will show you more about why your results are what they are than any strategy course or indicator ever could. If this video gave you something real to work with, leave a like. It tells me that this kind of content is worth making more of. Subscribe if you are not already, because what I am covering next is directly connected to this. In the next video, I am going to break down the specific mindset trap that makes traders repeat the same behavioral mistakes even after they know exactly what they are doing wrong. Knowing the problem and breaking the pattern are two completely different things, and most traders are stuck in that exact gap right now. You will not want to miss that one.